Hello and welcome to the Life by Design podcast, brought to you by Strategic. This podcast is all about helping you live your great life. Each episode will feature insights from our Chief Investment Officer, Doug Walters. Hello and welcome back to the Life by Design podcast. I'm here with Doug, and we're going to talk about our weekly insights from the past week, but then also we're going to get in a little bit deep on a subject that I particularly enjoyed from this past weekly insights, and I'm really looking forward to our conversation today, Doug.
Yeah, looking forward to it, Jay. Let's get into it.
Yeah, so let's just start at the top. So on our weekly insights, you had the headline of the week as the Fed, basically.
Yeah, I mean, a lot is still hinging on the Fed, and that is hinging on tariffs. So, again, we sound a little bit like a broken record. Those are the two main issues that are driving the market, and we really saw that come into play this week. There were some talks about whether or not the Fed chairman should be replaced, and the market didn't like that, and those comments were drawn back, and the market rebounded a bit. So you can see just how sensitive equity prices are to these conversations around the Fed and their ability to cut or not cut rates based on what they're seeing in the market.
Yeah, and it's very interesting because I think a lot of the hot topics that we feel like we're on repeat changes daily. So it's difficult for us to dive deeper into those because honestly, by the time we record this and we put it out, things could be completely different.
Right.
So we just give you like a little headline of like, hey, this happened. And then we'll, which leads me into the second thing, as we're recording this, the Q1 earnings season is in full swing, as you put it in the weekly insights. And so that's another thing that's where we're kind of looking, and the market's going to be looking as well.
Right. Yeah. And as you think about earnings, a lot of times what you'll see is the headline, right? So, Tesla reports earnings, earnings down 70%. And it's not insignificant, but really what analysts tend to look at is, what is the forecast, right? Because that's what's, when they talk about earnings, that's what happened. It's really about what they're expecting going forward. And I think what a lot of analysts are looking at right now is the conversation around tariffs, what companies are saying, how it's impacting their projections. You have seen some companies just pulling their projections, saying, hey, normally we give quarterly guidance. We're not giving any this quarter. So you're starting to see that bleed into these company announcements.
Yeah. And I think for our listeners at home, again, there's a lot of different conversations and a lot of different pieces moving that all affect this. And, I think some of the uncertainty too, that looking forward to and kind of understanding what's going on. But, there's the purchasing managers index, there's retail sales, there's all these other things that all add into the equation.
Right. Yeah. And it's, each one individually arguably is a little bit of a noise, right? They're, for the most part, they're insignificant, but, taken in aggregate, that's where you start to paint the picture of what's going on in the economy. When we look at the economy, we don't look at any one measure. We look at aggregate measures of PMI and, other, real estate starts. We look at all of these things together to see what sort of economic activity is being projected for the future.
Right. And then trying to discern mountains and molehills, right?
Yeah.
So that's kind of, I know that was a little quick for everyone at home, but that's, as the volatility of the market continues, for us, we'll give you the headlines here, but I think there's a more important topic that I really was excited to dig into. And this is this concept of shiny objects that you've brought up before in other weekly insights. But I think what touched me this week was more of, as you put it, guaranteed mediocrity, which was a very interesting twist on it. So I think where we'll start is let's just kind of talk about, if you can, both during when the market's up and when the market's down, like what are these shiny objects, and why does, I don't know if there's a reason, but why does it happen?
Right. And this is not a technical term, shiny object.
Yeah,
It's
yeah,
one
yeah.
we just tend to use internally.
Yeah.
But it really just refers to these products, and I'll call them products because that's what they are, that tend to generate excitement at different points in the market. And we tend to generally think about these as, especially with that term shiny, is these opportunities for excess return, right? So if it's, whether it's meme stocks, jumping on board that train, or NFT art. Remember
Yeah.
that?
Yeah.
That was a big one a few years ago. Cryptocurrency, obviously. The one we talked a little bit more in detail about in this piece were the SPACs, so special purpose acquisition companies, which were all the rage a few years ago, if you recall, or maybe you have
Yeah.
no recollection
No
of
recollection
that.
of that. Yeah. Yeah.
But those are really interesting because literally the sort of nickname for them are blank check companies. And it's really, imagine, a few friends of yours come to you and say, Jay, hey, we've got this great idea. We'd like to, collect money, and then we're going to invest in a business.
Okay.
And you're like, all right, what business are you investing in? And they're like, yeah, we can't tell you that, but just give us some money, and, we promise everything will work out fine. That's literally what a SPAC is. You can't know what they're investing in until, you've given them their money. So that's why they call it a blank check company. You're just handing over money, crossing your fingers and hoping that management knows what it's doing.
Yeah. Okay.
And the idea was, it to be a little less cynical, the idea was for the average person to be able to participate in, the early stages of a business, right? Sort of in the launch of a business, and that sort of excited people.
So, right. So kind of touches on the like venture capitalists, Shark Tank idea, but for the regular person, right? And just going, oh yeah, I want to be Mark Cuban or whoever, and I want to invest in this company, and then that gives them an opportunity to like participate in that.
Right.
Okay.
Right. And we know generally most of them did not do well.
Yeah.
And I just thought, well, as an exercise for writing this article, I just literally Google searched, SPACs to see what would come up. And one of the first articles was from US News and World Report. It was from 2021, and it was highlighting these ETFs that invested in SPACs. And the article was, was a little skeptical about SPACs, right? It was saying sort of the right things. These are very risky. You're handing over your money. You don't know where it's going.
Yeah.
But, if you invest in this ETF structure, you're buying a basket of these SPACs now. So you're, spreading your risk out, and hopefully one of them does very well. So I looked up the three they were recommending in the article, and they've all done terribly since then. So, but I think that's kind of a common tale with a lot of these SPACs.
Yeah, I think some of the numbers were, a couple were down over 40% from the date of the article.
Yeah, and then they just closed. They decided to close a year later.
Yeah,
and there is one of them still around today, but it's significantly underperformed U.S. equity market.
and so now a lot of the examples we just talked about, NFT art, meme stock, meme coin, right, and cryptocurrency, are all kind of examples and of when the market is doing well and there's money to be not only made but to be placed, right, as well, and to be used. So now that this landscape's kind of changing and the stock market's a little bit weaker, we're seeing it in a different way.
Right. Yeah, and it's really, in both cases, the producers of these products are sort of playing on emotion, right? Oh, everyone's, when things are going up, it's FOMO, right? I don't want to miss out on this. When the market's has a period of weakness, people are nervous, right? They're nervous about their nest egg, they're nervous about their investments, and they're looking for some reassurance, right? Some way to maybe protect that. And so these products are out there, and they've been out there, but they start to get pushed more when the market's going down. And I'll kind of pick on buffered ETFs,
Okay.
which are sound great when you hear sort of the concept. They use options to limit the downside of ownership of, say, an index like the S&P 500.
Okay.
So you can have exposure to the S&P 500, but at a certain point that downside is limited, and they use options to make sure that happens. But that doesn't come for free. So you have to also limit the upside to pay for that limit on the downside.
Okay. Yeah.
So, and that's where sort of the term sort of, guaranteeing mediocrity comes from. You are not going to do super well, and you're not going to do terribly either. And for the pleasure of having that mediocre performance, you're going to also have to pay a higher expense ratio because it costs money. These options are not free, and
right.
The managers are looking for compensation for their work in putting together this product.
Okay. So yeah, right. So you're basically, yeah, you in an attempt to cut out the risk of the stock market, you're actually potentially risking more money because you're spending it in order to avoid the risk.
Right. And I'll put it in slightly different term.
Yeah.
Right. The way I think about it is, if you look statistically at the equity market, statistically it goes up quite a bit more than it goes down.
Okay.
So you are statistically going to be paying for that buffer on the upside with the capped upside, right? You're going to be missing out on the upside more than you're going to be missing on the downside. So, and that's where, again, that sort of mediocre performance comes from. You're not going to be keeping up with the market when it's in a normal period of strength. So that's why these products get pushed when the market's weak. Great. I'm going to, limit my downside. But what if, the weakness is over, right? And you just reshuffled your whole portfolio, maybe sold something, taken some capital gains, and now you've got a product that's going to, just guarantee mediocre performance.
Yeah, and because it also kind of falls into right, you just did all the work, like you said, to get it there. And do you want to do the work again to get it somewhere else, to go right back to potentially where you were? Or even like the problem of, oh, hey, I moved it into this, and then maybe I moved on with my life and just go, okay, phew, right, my money's safe now. And then I just move on, and then it's still in that when now the market's back up and you're going, well, why aren't I getting these returns? Like the market's up again. You're like, well, you've been in this safe haven for a little, quote unquote, safe haven.
Right. Yeah. And I'll say two things about that. One is there are easier ways to do what this is trying to do without having to buy a product that has, an above average expense ratio. You can reduce the risk of your portfolio, right? So if you are a, say, aggressive investor, maybe 85% of your assets are in equities, you can cut that down to 75 or 65. And that's another way to effectively reduce your downside, and you can stay in cheaper index funds or cheaper ETFs and not having to pay that extra expense ratio. So there's other ways to reduce your risk if that's your goal. This is just in my view, a very expensive way to do it.
Okay. Yeah. Well, and I think, to go back to other conversations that we've had, it also, to me, is kind of that conversation we had about reacting in the moment, right? And saying, oh, this is happening right now, I should do this, versus like waiting and having a more nuanced conversation about what you could potentially do, looking at it from like a 3 to 5 year standpoint.
Right. Yeah. You always have to focus on that long term. And while we try not to repeat the same message every time, Jay, I have to get it in there, at least once. But, it's really suggesting that you can see the future, right? Yeah. That you are predicting the future and the market is going to go down. therefore I need this product. If you know the market is going to go down, again, there are better ways to take advantage of that than buying a buffered ETF.
Hmm.
But you don't know. Even the best experts out there cannot predict the future.
Hmm.
Anything can happen on any given day, and so you really need to play that long game.
Yeah, and so I guess then, in both times of ups and downs, the recommendation really is to not focus in the moment of whatever the market is doing up or down and try to, over capitalize on it, I guess, or try to play the lottery or the slot machine, but is to look at what's been working for you over the last X years and say, oh, okay, well, this seems to be working. So,
Right. Yeah, it's a long-term process, and there are moments in the market where opportunities open up. So it's
mhm,
not like you just do the same thing
yeah.
all the time, but you're looking for real opportunities. And I'll give sort of a counter example to that. And when I know that they're shiny objects is when my email gets blown up by, I come in, I have 100 emails, and half of them are buffered ETFs. Or also another example we didn't talk about in insights is gold,
Mm,
right? Gold is a safe haven. Now is the time to own gold. And yes, we own gold in our portfolios, but where were these emails 2 years ago,
yeah.
before gold really started to rally? I mean, gold is at an all-time high now. Is now the best time to be piling into gold? Again, can't predict the future, but it's certainly not as good of a time as it was 2 years ago. So
Right,
where
right,
were
right.
where were these emails 2 years ago?
Yeah.
So just be very be very cautious when
Mm,
your email or the ads you see on the TV start focusing in on something like gold or
yeah.
buffered ETFs or whatever it is they're trying to sell you. Chances are you've already missed the boat.
Yeah. And yeah, so I think for those of you at home, I just thought that this was a really great topic because for me, particularly, the shiny object idea makes more sense during the high times because it's like, oh yeah, you've got money, you've got this, like why don't you put it in this, right?
Yeah,
And it never occurred to me that during the lower times that though that it's that same concept, it's just packaged in a different way.
right.
Yeah.
Right. And again, playing a little bit of the cynic here, and that, we have great partners on the ETF side that provide fantastic products
Hmm.
for us. We are always looking to make sure that we are getting a return that justifies whatever we're paying for that product,
Mm,
right? If we own an ETF and it's not just a plain index fund, why is it? We have the multi-factor products in a lot of our strategies. Why do we have those? Well, they tend to outperform, and they tend to outperform in a way that justifies their price.
mm,
So, a lot of these offerings that you see coming out just aren't, justifying the price. Um, Again, I guess going back to the point I was going to make is, these providers have to make money somehow,
yeah.
right? An index fund, they make almost nothing on those. Some of them are charging 3 basis points, 5 basis points. They're making almost nothing on those these days. They have to find a way to make money. They're going to
Mm,
put these out, hope that people buy them, and try to generate that excitement. And we just want to make sure we're excited about things that genuinely are going to add value to a portfolio.
yeah. Yeah, I love it. Well, and I think that's yeah, I think we can end there. And for those of you at home, I hope that that was some good insight into shiny objects and what can happen during these times of volatility.
Yeah. Well, thanks, Jay.
Thanks, Doug. This podcast is for educational and informational purposes only. Please see the full disclosure in our show notes for more information.